Hello, everyone, and welcome back to Your Finance TV. It's been a bit of a week's break since I've had a chance to sit down with Jay, but here we are. Welcome back, Jay.
You're looking rested and tan, Scott. How was Florida, buddy?
It was fantastic, fantastic. And you know what? I had a look at your musings this week, and I always enjoy having a read of them. But the title this week brings back a few nightmares from of breaking out like a teenager. I remember having a few pimples when I was a teenager. How'd you come up with that title?
Well, you certainly are a handsome guy right now, man. So whatever happened, it's in the past. You're fine. Don't worry about it. But yeah, I mean, it's funny. I also have, teenage boys or kind of young adults. But anyway, breaking out like a teenager, right? We've all been there. And those of us who are parents of teens or young adults are there again. And it happens to everybody. And it's like from one day to the next, right? Day one, your face is looking good, and then the next day it's blotchy, it's pimply, and from one day to the next. So that just really that kind of speed thing. We've been talking about speed in the markets for years. So I always like those analogies, and this one just seemed, too perfect to not use. So, and we could be talking about many different things, right? There's so much to talk about. We could be talking about inflation, right? Which a lot of people are talking about and which seems to be heating up again. We're not going to talk about inflation. We could talk about the US dollar. People talk about, the wrecking ball, the strong dollar, the dollar breakout, but we're not talking about that either. What we're talking about is China and Chinese equities, which are breaking out like rock stars right as we speak.
Yeah, well, like, listen, you and I just before we jumped on, were talking about it. Obviously, we didn't do a show last week, but everyone talked about how the market was coming to the end of the world last week. But essentially, over the last 2 weeks, it's pretty well flat. And you talk about there China, like China's been a big performer. Touch on that a bit more.
Yeah, it's you're absolutely right. U.S. have been flat, notwithstanding all the thousands of words written and talked about inflation, growth, Fed rates, etc. But hey, across the world, over on the in the East, China is rising and China equity is rising. And look, it's been a rough road for China, right? We talk about in the musings about China tech being down for 3 years in a row. That it's trading at 15 times this year's earnings versus Nasdaq trading at 24 times earnings. So China tech trading at a 40% discount. We talked about the fact that no one is in China anymore, right? People are completely underinvested. Even the Chinese themselves can't get enthusiastic about equities. So it's a really a compelling story, and it's a story, as you know, and some of your loyal viewers know that we've been on for a while, writing and talking and having a position in China for some months, really since the fall. So it's been a little bit of a wait, but it's exciting to see it finally starting to develop. And our main play here is in China tech, right? So we are ETF focused here at TPW Advisory. And in our global multi-asset model portfolio, which is our flagship, we've had a pretty healthy position in KWEB, KWEB, which is the China tech ETF listed in the United States. And so that's our play, and it's exciting to see it really starting to take off.
Yeah, you've talked about KWEB a lot over the last probably 4, 5, 6 months. And you can see like you've talked about like where the value really could be. Like if it doubles and doubles again, I think you've said then still hasn't really caught up to where it needs to be compared to its US competitors.
Yeah, absolutely right. Thank you for remembering. We have made that point repeatedly that KWEB, and we were saying at 25 or 26 bucks. Happy to report today, my friend, 28.60 and heading north. But we've made the point that KWEB could double, so from 25 to 50, and then double again from 50 to 100 before it got to its March 2021 high of about 102 bucks. So now we're at $28 heading north, and the story is compelling. right? The story really is compelling. And so we reference not just our work or our opinion, but we reference JP Morgan, which does some really solid work on China in their earnings outlook, which they see earnings growing at 14% year over year in China, which is significantly ahead of where U.S. consensus estimates are. They note that they've seen upward revisions, that the story for the internet names in particular is improving because of what they say increasingly more benign competitive dynamics in the domestic market, improvement in online penetration across key internet verticals, and strong digital content supply in the next few quarters. JP Morgan sees increased likelihood of earnings beats and upward revisions and has turned more positive on the sector share price outlook over the coming 12 months. So look, that's a great encapsulation of the argument. And so KWEB has acted like a champ. We wrote last week, you and I didn't speak, but TPW Advisory, we had a musings go out, and we wrote about how KWEB needed to recapture its 200-day moving average. It had poked its head above it. Then last week, with some of the negativity, fell below it. And now it has come back like a champ and is well above the 200-day moving average. Handled the TikTok news right on Tuesday. U.S. Congress passed a bill banning TikTok. KWEB was up 2% that day. 2% on the day that the news headlines are very negative. And it's been higher over the rest of the week. So here's a couple of stats for you. Over the last month, KWEB is up 10%. Over the last 3 months, KWEB is up 15%. That compares to XLK, which is the U.S. tech ETF, which is down 3% over the last month and basically flat over the last 3 months. So all the talk about the Magnificent Seven and tech and NASDAQ, China tech has been a material outperformer, up 15% over the last 3 months, while U.S. tech is basically flat. And that's a story that, many, many more people need to be paying attention to than have paid attention to date.
Let's do a little bit of a pivot. Let's talk about the US dollar, shall we? You've been talking about it like maybe coming to like maybe not being as strong. Maybe I'm being a little bit gentle on that sort of side. Like it feels like a lot of people have been caught on the wrong side of this trade in the US dollar. Like, are we going to see a pullback at any stage in this?
Well, that's another one of our themes that we're really starting to develop, and we're gonna do more on this. We have our May monthly coming up next week, which is our deep dive, and we do expect to talk quite a bit about the dollar. And look, we're developing a thesis that suggests the dollar could be at risk to a momentum break, much as the momentum tech stocks have kind of rocketed up and then fell like a stone, right? The Magnificent Seven, et cetera. Pretty much NVIDIA, as we I believe wrote last week or the week before, NVIDIA, which is the AI poster child, has fallen 20% from its recent peak. So that's a momentum trade that was very strong, sucked everybody in, and then dropped. And the dollar setup is kind of interesting, kind of similar. It hasn't been anywhere near as powerful, right? We talked at the open of the dollar really not doing very much, but over the last year, it's up about 4%. But certainly the tone in the conversation around the dollar is the dollar wrecking ball, the strong dollar. The IMF meetings were full of talk about the strong dollar and the risk to the world of the strong dollar. So our thesis is that you have a similar situation where speculators have their biggest net long position in the US dollar in 5 years. You have all this hype around the dollar. And to us, it strikes us as late cycle, extended, overbought, all of which arguably you could have said about the Magnificent Seven a month or two ago. And so we're trying to come up with the catalyst, right? What would lead that dollar rollover to occur? And, could it be a Trump victory, right? He's out there talking about massive tariffs on China. Could it be the worries about growth in the United States, right? Q1 came in lighter than expected on the headline. A big part of that was because imports have surged. Imports are surging because the dollar is strong and sucking in offshore production. Could it be the ECB cutting rates, which for now, for sure, the ECB will cut rates before the Fed? What happens if the ECB cuts and the euro, instead of falling, strengthens because that cut is seen as pro-growth? That's the one right now, Scott, that I'm thinking about. That could be the tell. And that could happen in the next 2 months, right? ECB is likely to cut rates in the next 2 months. Inflation there is very well under control, running at 2% per annum. So an ECB rate cut could be the catalyst to send the dollar rolling over. And if that happens, lo and behold, a couple of things that we like a lot here at TPW Advisory: emerging markets, commodities. A weak dollar would definitely be helpful to those two segments of the global asset class. And so that's one of the things where you can rest assured we'll be talking more about that next week.
Listen, before we wrap up on this today, I want to bring to the attention the viewers who haven't read the musings, but go to Pelosky.com to sign up for those. But let's have a little bit of a look at the IMF meetings at the bottom. The last point you have in there today, and I think you and I have a pretty similar view on the IMF, is like anytime they come out with something, it's wrong. Tell the viewers what you have, that last little point you have in your musings this week.
Yeah, it's a classic, right? We talked over the last couple of weeks about the IMF World Bank meetings. It's kind of like a Davos event, or the Economist covers, right? Pretty much famous for contrarian thinking, right? Or consensus thinking that you want to go against. And so I have a buddy who's been going to these for decades, and he's an investor. And one of the things he likes about the meetings is that it's a confluence of macro thinkers, government officials, academics, and real money investors. And so he pointed out to me when I talked to him, I always get a download from him, right? Because I don't get invited. So he gives me the download, and he told me about the JP Morgan survey that was conducted during these meetings last week. And relative to our point about China, 3% of those surveyed in the IMF meetings were overweight Chinese equities. Okay, so that was one. You got to love that. And then relative to the dollar, what we were just talking about, a staggering 82% of those surveyed expected the dollar to be stronger a year from now, or by the end of this year. So there you go, right? We're making the case that China is breaking out like a teenager, and yet 3% of the IMF attendees are overweight. We're starting to make the case that the US dollar is ripe for momentum rollover, similar to big tech. And the IMF people say 82% surveyed says stronger dollar over the course of this year. So classic contrarian indicator that we wanted to highlight to our clients, and obviously to the folks watching YourFinanceTV. So
maybe you should create an ETF, the opposite of whatever the IMF says.
Exactly.
You'd be like the short ARK ETF.
Indeed.
Listen, Jay, thank you so much for your musings this week, and we look forward to getting a monthly next week.
Exactly, Scott. Great to have you back from vacation, buddy. You're looking great, and we'll see you. We'll see you and your viewers next week.
Thanks, Jay, and for everyone else out there, good luck investing.